In this video, guys, we're going to look at choosing good trading targets. Got the screen in front of us now. Let's look at some examples. Stay tuned for this one. Hey traders, a very warm welcome to you. Okay, let's get straight down to it. Choosing a good trading target. I like to split my trades up into two distinct categories. One outside in and one inside out. What do I mean by that? So inside out is a trade that you're taking of a continuation, i.e. we're in the middle of a range, or we're kind of at the top of a range, or whatever, or we're in a breakout. The idea is we're extending that move, we're extending it. It's inside out as opposed to outside in, which is the other way around, i.e. we have already made a move and we want to come back into some prior area of trade. Mean reversion, continuation, another way of putting them. So targets are going to depend on which type of trade that you are taking, what your strategy is, what your setup is, all that kind of stuff. Let's say we are taking an inside out trade. In other words, a trade that is looking for an explosion, a move to the upside, a continuation. How are we going to use trade targets for that? Well, the obvious one on price action is going to be things like prior highs, prior key levels. Let's say, for example, that we'd bought this euro US dollar chart on a 1 day down here. Hypothetically speaking, what will be a good initial target for us? It's probably going to be that prior high, because it's an inside out trade. That's an out trade. We'd probably want to scale out into that position. Another way of doing it is to look at the whole numbers: 123, 124, 125, even better. Nice whole number. In fact, it happened to be the top, but just because it happens to be there. But the idea is it works well with crude oil, works well with stocks, works well with all those kind of stuff. Look at those whole numbers. Another way is to trail it with the moving average. So have a moving average and trail it up with it and let that thing run. Let that thing run as far as it will go. So when you're looking for those inside out trades, you're looking for, you know, just things up in fresh air where the market could get to. Another way of looking at it is to kind of extrapolate what's happened and say, well, hey, you know, we've already moved up from here to here. You know, how far was that? Okay, 1,742. We moved down from here to here. How far was that? Okay, 300 pips. So I know I'm expecting maybe twice that. Maybe I'm expecting twice the move there. So we have 300. You know, we were looking at 700, and it's about right. So you can, I mean, I'm really being rough with this, but you can kind of take little chunks of where were we, where could we go, and extrapolate that out and say, okay, that's how far we could go. And head and shoulders, the classic one is to use the head distance from the neckline to the head and extrapolate and flip that over so you can see where potentially the market could go. So that's one way of doing it. Another one, if we're using that inside out strategy, guys, is just to allow ourselves room to think bigger. If we're in a trade that is working for us, we want to let it pay us for being right, while still having the right expectations from it. What do I mean by that? So let's say we are day trading. Okay, we're a 15-minute chart. The average daily range of the market we're trading is 200 ticks, 200 pips, whatever it may be. We've gone long. The market's moved. We've gone long. It's already done 150 pips. We've gone long, it's got another 50 pips, we're now up 200 pips. Can we expect another 200 pips? No, we can't on that day. Could it happen? Of course it could, but the expectation is not. The expectation is for a 200 pip move, give or take. So it would be imprudent of us to expect that each and every time. From the right conditions, we might get a real extension day, but we need to put that in perspective. However, it doesn't necessarily mean we can't say, you know what, I need to hold this for 2 or 3 days, but then we can set our expectations. If we're looking for 1,000 pips, it's not going to do it on 1 day. It might take a week, 2 weeks, 3 weeks with a bit of oscillation. So it allows us to be a little bit more measured in what we're expecting. Another final thing, if we're day trading, guys, is if we take a trade, hold it to the close. That's a really good marker point. If you're on the end of a good move like this DAX, for example, here, just happened to be up on the chart, for whatever reason you're in long and it's powerful and it's strong, forget about your targets. Let there be a natural exit for the trade, which is when everyone has to close the position. If they're trading stocks, or if they're stock short intraday, for example, at the bell, let that be your marker point for coming out. Of course, protect some profits with a trading stop, but it's just a really good way of sitting on your hands, because I know that day traders, we have trouble sitting on our hands. We want to take profits, we want to move on to the next one, but when we're on the end of a good move, we've got to let that market pay for us. Okay, so let's flip it around. Let's look at outside in. How would we position our trades? Well, actually, while we've got this the intraday chart of the DAX up, we would use something like a volume weighted average price. We're looking for some kind of mean. In a mean reversion trade, we're looking for something that's going to help us decide where a mean is, and that's going to be a volume weighted average price, which I've got on the chart here. That could also be a moving average. So let's say we had shorted here for, again, whatever reason. I can't see a good reason for it to scroll out. Maybe there was one, but hypothetically, we wouldn't be looking for necessarily for a complete reversal unless we're in a bigger picture that would indicate that's possible. But let's assume we're not for now. We're in a little bit of an uptrend. We've spotted some kind of turning point, double top, whatever it may be. We're not looking for home runs on outside in. We're looking for mean reversions. So your job as a trader is to find the mean and to use that as a target. That would be moving average, a VWAP, or we can take a proportion of the move and say, okay, that's moved however much that was, 200 pips, 400 pips, whatever it may be. I'm going to take a third of that and use that as a fixed target, because I think if we are in a trend and we're retracing a bit, that's a sensible way to kind of aim for things. So two distinct different ways of doing it, guys. Outside in, inside out. One's mean reversion, so you're looking for a mean as a marker point for your exit, and when you're going for those trends, when you're going for those explosions, you want to kind of use your extensions, you want to extrapolate market conditions and add that on, and you want to just let that thing run. When that's working for you, let it run, because those are the ones that are going to pay you for being right. All right, guys, take care. See you in the next one. Bye bye.